Is autopilot investing really as safe and effortless as it's often made out to be? Set it and forget it sounds like the golden ticket. Just pick a fund, pour in your money, and watch wealth build up without any stress or second guessing. But is it that simple? Today, on the Capital Breakdown, we're getting real about passive investing. By the end of this video, you'll understand what set it and forget it really means, what it can and can't do for your financial future, and how to manage your expectations so you're prepared for the ride. No hype, just clear facts and solid insights so you can make smarter decisions with your money. There's a widespread belief that passive investing is completely hands-off and risk-free. Many people hear about index funds or ETFs and assume it's like putting your money on cruise control. The idea is, set your contributions, and the market will do the rest. But here's the catch. Markets move up and down, sometimes wildly. If you've ever put money into something and then panicked when the value dropped, you know it's not always smooth sailing. Plus, some folks forget that passive doesn't mean no maintenance. Just like you wouldn't ignore your car's oil light for months, your investments need occasional check-ins. Understanding this gap between expectation and reality is key. So what exactly is passive investing? Picture your money like water flowing into a big bucket that's designed to catch drops from many rivers. In this case, the bucket is an index fund or ETF, a type of investment that holds a little piece of many companies, usually tracking a broad market index like the S&P 500. Instead of trying to pick winners one by one, passive investing spreads your money across a whole market or sector, aiming to match its overall performance. The set it and forget it phrase means you don't actively trade or try to time the market. You just keep adding to your bucket regularly and let the market's collective growth do the heavy lifting over time. But here's the nuance. Passive doesn't mean zero involvement. It's more like setting up a garden sprinkler system. You install it, set a schedule, and it waters automatically. But you still check on it now and then to make sure it's working right and hasn't sprung a leak. And what about fees? Passive funds generally have lower fees than actively managed ones, but they're not free. Those fees cover things like fund management, trading costs, and administration. Over years, even small fees can add up, so it's smart to be aware of them. Understanding these basics helps you see the full picture behind the set it and forget it label. Now, let's peek behind the curtain. When you invest in a broad index fund, your money flows through a few key players: fund managers who maintain the portfolio, brokerage platforms that facilitate buying and selling, and regulators who set the rules to keep markets fair. Fund managers for passive investments don't pick stocks individually. They buy shares to mirror an index's composition. Meanwhile, brokers act like the middlemen, executing your orders and holding your assets in your account. And regulators keep an eye out for fraud or manipulation, giving you some layer of protection. But remember, the market itself still has natural ups and downs. These players don't eliminate risk, they just help manage the process smoothly. Behind the scenes, money is constantly moving. Investors add cash regularly through contributions or withdraw funds when they need cash or rebalance their portfolios. This flow can cause small price fluctuations, but for large, broad funds, that's usually just noise. Fees are deducted automatically. You won't see a bill, but the returns you get are net of those costs. Even in a passive fund, there's some activity like rebalancing and index tracking adjustments, but it's far less than actively trading stocks daily. So when you're thinking, set it and forget it, it's really about minimizing your involvement, not eliminating it entirely. Let's walk through two simple examples. Imagine Sarah, who invests $200 every month into a broad market index fund. She doesn't check prices daily or try to time the market. Over years, she experiences ups and downs, but by sticking to her plan, she benefits from dollar-cost averaging, buying more shares when prices are low and fewer when prices are high. Emotionally, this approach helps her avoid panic selling during downturns. Now consider John, who instead puts his money into a single speculative stock, hoping for a big payoff. This route is riskier. That stock might soar, but it could just as easily plummet. John's emotional roller coaster is intense, and one bad move could hit his portfolio hard. These examples highlight how different strategies create very different experiences and risks. Both Sarah and John have choices, but it's critical to understand the risk profiles. Sarah's diversified approach tends to smooth out volatility over time, while John's concentrated bet exposes him to sharper swings. Passive investing can feel safer, but it's not without risk. Market downturns affect broad funds too, and if you pull out your money at the wrong time, even a diversified investment can lose you money. Time horizon is your best friend here. Investments need time to recover from drops. Patience and realistic expectations are essential. No investment is a guaranteed win, and understanding what you're comfortable with emotionally can make all the difference. Where do things go wrong? Common traps include overconcentration, putting too much money in one stock or sector, which increases risk. Another is leverage, or borrowing money to invest, which can amplify gains but also losses, sometimes catastrophically. Some investors forget that investing is a long-term game and panic during short-term volatility, selling low and locking in losses. Others underestimate fees or tax implications that chip away at returns. And finally, not revisiting your goals or strategy can mean your portfolio doesn't align with your changing needs. The best protection is knowledge, patience, and a clear plan that you're willing to stick with through thick and thin. So how should you think about passive investing in the big picture? It's one tool in your financial toolbox, not a magic solution. Before investing, having a solid budget and emergency fund is crucial. That way, you won't be forced to sell investments during a market dip. Passive investing often fits well with long-term goals like retirement, where you can afford to ride out volatility. It's also wise to review your portfolio periodically to ensure it still matches your risk tolerance and timeline. Remember, investing isn't just about chasing returns, it's about aligning your money with your life goals and comfort level. At the Capital Breakdown, we always emphasize seeing investing as part of a balanced financial life. That means budgeting wisely, saving consistently, and having clear goals. Passive investing can help your money grow steadily over time if you're patient, diversified, and aware of risks. It's not set it and forget it in the absolute sense, but rather set it and periodically check it. Keeping your expectations realistic means you're less likely to panic and more likely to stay on track. When you combine a thoughtful approach with education and regular review, you build financial confidence and resilience. Before we wrap up, a quick reminder. This video is for educational purposes only. It's not personalized financial advice. Everyone's financial situation and goals are different, so it's important to do your own research and consider speaking with a qualified professional before making investing decisions. Taking the time to learn and plan puts you in control and helps you avoid costly mistakes. The Capital Breakdown is here to give you clear, practical knowledge so you can navigate the investment world with confidence. To recap, set it and forget it investing is really about minimizing active trading by investing regularly in broadly diversified funds. But it still requires understanding risk, fees, and market ups and downs. Patience and a clear plan are your allies. Avoid traps like overconcentration and impulsive moves, and always keep your financial goals front and center. Thanks for joining me on the Capital Breakdown today. Keep learning, stay steady, and remember, you're building your financial future one smart step at a time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.